Hi guys, so let's now work through 21 to 25 on the 2011 paper. So what is the most likely short-run consequence of an increase in a country's balance of trade deficit? It's the most likely short-run consequence of an increase in a country's balance of trade deficit. Okay, so just think about this. This is simply x minus m that we're thinking about here. So what will be the impact of this? So if imports are rising, exports perhaps falling, what would the short-run consequence be? Well, it will not be an increase in the level of national income because you've got more money going out of the economy. An increase in the level of unemployment, yes, well this is likely. The reason being because there's perhaps less demand for the export products that are being sold overseas. Increase in the money supply, no, because again more money is actually leaving the economy. An increase in the rate of inflation, no, that's incorrect because again aggregate demand is being taken out of the economy. Okay, so the answer therefore would be B. Right, number 22. Which combination must result in an increase in a government fiscal deficit? Okay, this is a tough question. This is really asking about a macroeconomic theory which derives from rearranging the components of aggregate demand. And it's about the different sectoral balances in effect, suggesting that the state sector's balance or the government's fiscal deficit will equal the private sector balance minus the external sector balance. Okay, so we've got the private sector surplus. So in effect, what would take place here is an increase in the private sector surplus. That would mean that the government's fiscal deficit would be likely to increase as a result of this. Further to that, what we're also likely to see when it comes to the trade deficit is an increase in the trade deficit. If you just think about the notion of this, really, what this is likely to mean is that a trade deficit may well damage tax revenues. Meanwhile, an increase in the private sector surplus may remove money from the circular flow of income, and thus less tax will be actually collected, possibly. But nevertheless, it is really about the principles of the state sector's balance equaling the private sector balance minus the external sector balance. So it would be from the perspective of D. Increase. Okay, right, number 23. Let's have a look at that. Okay, so 23, we've got Lorenz curve. Curve X in the diagram is an economy's initial Lorenz curve. Which combination of policy changes could cause the Lorenz curve to shift to curve Y? So we can see that at the lower end of households in the sort of middle area here, the average number of households here, we can see that there's been a slight improvement towards the line of equality, which of course would go along the line of the pencil I've just put in place there. Meanwhile, at the top end here, we can see that there's actually been an increase in inequality at the top end. So what does this mean? Well, let's just zoom out there and pick up some of the potential answers here. So which combination of policy changes could cause the Lorenz curve to shift to Y? Okay, well, state pension. Well, for this area, thinking about this area here, yes, we are likely to be focusing on an increase in the state pension. What about this area? What is making these people at the higher end of the income status here better off? Well, of course, it would be a decrease in the level of in the higher rate of income tax. So we could see that the answer will be C. Okay, so moving on, 24. Why does manufacturing output usually fall by more than service sector output in a recession? Okay, so If you think about manufacturing output involves producing stock. It also involves work in progress. That's another key component of stock, as are raw materials. Now, during a recessionary period, manufacturers will try to use all of the existing raw materials that they have and turn them into finished products and sell through the existing stock levels that they have. So carry out a process known as destocking. Of course, the service sector doesn't have the actual ability to produce output in advance like that, apart from if it's a digital-based service product. But generally speaking, if we just run through these answers, we can see that D does have that point regarding destocking. So manufacturers usually respond to a fall in consumer demand by destocking. Okay, 25. Country X's currency is pegged to the US dollar. What will be the likely impact on country X of depreciation of the US dollar against other currencies? So here, well, if the dollar is going down in value, and that will mean country X's currency will depreciate in value, then firstly, there won't be an improvement in the terms of trade. Now, it may well mean that country X's goods are far more price competitive, but that will not generate an improvement in their terms of trade. If you think about the way in which that's calculated, that is the index of export prices over the index of import prices times 100, okay? So, no, it's not that. Next one, an increase in its inflation rate. Yes, well, this is far more plausible because you now have that concept of weak pound, imports dear, exports cheap. So therefore, the price of imports would rise. Okay, so that's the crucial feature here. So the answer will be B. Okay, an increase in unemployment, just quickly. Well, it could actually lead to an increase in employment in those export areas that are now more competitive, an increase in the trade weighted value of its currency. No, answer is certainly